Silver closed this week at $75 an ounce. Not a dramatic crash, not an explosive breakout, just $75. If you only looked at the surface level data, you would think absolutely nothing happened. You might believe the global economic machine was simply humming along in perfect equilibrium. But beneath the static, beneath the carefully constructed illusion of stability, 5 tectonic macroeconomic shifts just collided in real time. 5 seemingly disconnected events, originating from the Federal Reserve cracking internally, to Tokyo abruptly intervening in global currency markets, all the way to a staggering $715 billion artificial intelligence infrastructure build-out. Most traditional analysts look at these events and see 5 separate isolated headlines to be consumed and forgotten. But when you look through the noise, when you peel back the layers of the consensus narrative, you see the unmistakable blueprint of a restructuring global financial system. Welcome back to Faultline Finance Channel. Today, we decode the convergence. We are going to connect the chapters of a story that ends with physical, hard assets repricing in a system that has been pushed to its absolute breaking point. The reality is that $75 silver is not a state of stagnation. It is the price of a global market caught directly in the middle of a violent, paradigm-altering transition. To understand what is truly happening, we have to look at the psychological architecture of the market itself. The masses are conditioned to react to rapid volatility, to the dopamine hit of a massive green candle or the sheer panic of a red crash. When an asset like silver holds at $75, the untrained eye sees boredom. They see a dead asset. But those who understand the esoteric mechanics of wealth accumulation know that stasis is almost always an engineered illusion. It is the deep breath before the tidal wave. It is the shadow integration of a global economy preparing to shed its old skin. The physical metals market is currently a tightly wound coil, suppressing immense kinetic energy. Every single ounce of physical silver drained from the vaults of the London Bullion Market Association. The COMEX is a mathematical certainty, pulling us closer to the breaking point. The architects of the current fiat paradigm are desperately trying to maintain the facade. But the foundation is cracking. What we witnessed this week was not random noise. It was the synchronized manifestation of institutional panic. We are watching the slow, grinding collapse of trust in centralized monetary authority, and the quiet, deliberate accumulation of real, tangible wealth by those who see what is coming. Over the next minutes, we will break down exactly how these 5 unseen forces are actively reshaping the hierarchy of global power, and why understanding this convergence is the key to surviving the coming wealth transfer. We will look beyond the screen, beyond the manipulated spot price, and into the raw physical reality. The spot price is merely a psychological construct, a shadow projected on the wall of the cave. The true value is being negotiated in the shadows, in the quiet corridors of power where central banks and tech giants are hoarding the very materials required to build the next iteration of human civilization. Let us begin with the first fracture. Event 1 is the institutional fracture. On Tuesday and Wednesday, the Federal Reserve held its 3rd policy meeting of the year, voting to keep interest rates locked at 3.5% to 3.75%. On paper, that was expected. But the true terrifying signal was hidden within the vote itself. 4 members explicitly dissented against the majority consensus. This is the most significant internal division we have witnessed since 1992. 3 of these dissenting members wanted to aggressively erase any hint of future rate cuts, demanding a harder, more hawkish stance. Conversely, 1 member wanted to cut rates immediately, citing an economy that is already secretly hemorrhaging. The illusion of a unified central banking consensus has completely shattered. We must understand that fiat currency does not derive its value from gold alone. It derives its value from a shared belief in the competency and unity of the institution that prints it. When the world's most critical monetary institution loses its unified voice, that collective assumption fractures. Institutional credibility rapidly erodes. During his final press conference, Jerome Powell effectively accused the executive branch of undermining the independence of the Federal Reserve. This was not a standard bureaucratic complaint. It was a flare fired into the night sky, signaling to global capital that the walls are being breached. As incoming chair, Kevin Warsh, prepares to take over on May 15th, the extreme tension becomes highly visible to anyone paying attention. Historically, when central bank independence is openly contested, sophisticated capital does not panic overnight. It does not rush for the exits all at once. Instead, it quietly, systematically, and ruthlessly rotates into hard, counterparty-free assets. Silver briefly dipped to $71 on the hawkish headline news as algorithms reacted to the noise. But the true underlying signal was severe, undeniable institutional stress. The market is attempting to manifest a new reality. The dissenters within the Fed are exposing the shadow of the system, the unspoken truth that they are trapped in a mathematical paradox. They are trying to talk down inflation while ignoring the structural realities of a fracturing global supply chain. This is not just a policy disagreement, it is an existential crisis of faith. When the high priests of the financial system begin to argue, the smart money quietly leaves the temple and buys gold and silver. They are preparing for the moment when the illusion of control evaporates and the laws of supply and demand violently reassert themselves. This transition of power to the Warsh era is a critical vulnerability. Markets despise uncertainty. An unpredictable, politically compromised Federal Reserve is the ultimate catalyst for a flight to safety. The fracture has occurred. The only question left is how long until the entire structure comes crumbling down. Event 2 is the hawkish double punch, a macroeconomic anomaly that perfectly illustrates the trap our system is caught in. On Thursday morning, two devastating pieces of data dropped simultaneously. First, core personal consumption expenditures suddenly accelerated higher than forecast, hitting an uncomfortable 3.3%. Simultaneously, initial jobless claims plummeted to a 50-year low. In a normal, healthy economic environment, a powerful labor market is a massive celebrated victory. But we are not in a normal environment. We are trapped in a highly volatile, stagflationary purgatory. This specific combination of data paralyzes the central bank completely. They cannot cut interest rates because inflation is visibly climbing, eating away at the purchasing power of the working class. They are forced to hold rates high, suffocating small businesses and draining liquidity from the system. But if you look closer, you find that this inflation is almost entirely driven by severe, acute energy constraints. Specifically, the geopolitical bottleneck in the Strait of Hormuz. Core inflation, stripping out food and energy, is relatively stable. The massive, undeniable spread is oil. Brent crude hovering above $100 a barrel acts as a hidden tax. It is an industrial noir reality. The engine of the world is running hot, choking on its own exhaust. This is where the narrative becomes highly actionable. If Brent crude pulls back, the entire inflation narrative flips violently on its head. A downside surprise in the CPI is the ultimate catalyst for monetary metals, effectively lighting the fuse for the next major breakout. The mainstream media will tell you that strong jobs mean the economy is booming. They are selling you a heavily curated reality. The truth is that people are working multiple jobs just to afford survival. The system is cannibalizing itself to maintain growth. High interest rates act as a gravity well, pulling capital away from productive enterprises and into the safety of government bonds. But this is a temporary distortion. The energy shock dictating this policy is an event-driven headwind. It has a definitive expiration date. When oil prices normalize, the illusory foundation of this hawkish narrative will vanish instantly. Suppressed energy and silver will be unleashed. Algorithms forced to cover short positions will drive the price upward in a vicious, parabolic short squeeze. We are witnessing the final, desperate attempts to manipulate the physical world through paper derivatives. This is the shadow of the macroeconomy, a system so fragile that a single naval blockade dictates your mortgage and silver price. The illusion of domestic economic sovereignty is dead. We are entirely dependent on the fragile, interconnected web of global energy. Events 3 and 4 merge into the most critical structural force of our modern era, an unstoppable physical build-out that borders on the metaphysical. First quarter, gross domestic product grew at a sluggish 2%, coming in below the 2.3% forecast. The traditional consumer economy is suffocating, but the single dominant force keeping the gross domestic product afloat is the artificial intelligence infrastructure race. We are witnessing the physical construction of a digital overmind. Meta, Alphabet, Microsoft, and Amazon just committed a staggering $715 billion in capital expenditure for 2026. Let that number sink in. $715 billion. That is nearly double their spending from the previous year. And this is where the esoteric, intangible nature of artificial intelligence hits the absolute unyielding limits of the physical Earth. These massive data centers are not built out of code. They are built out of copper, steel, and most importantly, silver. They require unprecedented power distribution networks and complex thermal cooling systems to prevent them from melting down under their own immense computational load. The binding constraint on the future of artificial intelligence is not software. It is electricity. And the essential, mathematically irreplaceable conductor for that extreme high-performance infrastructure is physical silver. It is a material science absolute. You cannot negotiate with physics. Whether silver trades at $75, $150, or $300 an ounce, these technology hyperscalers are completely price insensitive. They are locked in an existential arms race for digital supremacy. The cost of the physical silver required for their servers and power conduits is simply absorbed as a mathematical rounding error in their balance sheets. They will buy every single ounce they need, regardless of the spot price. This represents a paradigm shift in the demand profile for precious metals. For decades, silver demand was somewhat elastic, tied to the ebb and flow of solar panels and traditional electronics. But this AI build-out is entirely inelastic. It is a black hole of demand, consuming the global above-ground supply at an accelerating, terrifying rate. The physical deficits we have seen in the commercial exchanges are not anomalies. They are the early warning signs of a structural shortage. The new architecture of the global economy is being built on a foundation of physical silver, and retail investors are completely oblivious to this reality. They are staring at the paper price, while the most powerful corporations on Earth are quietly draining the physical vaults. This is the ultimate manifestation of the hidden architecture. The digital realm is aggressively colonizing the physical realm. Silver is the primary bridge between the two. As we push further into this technological epoch, the true value of highly conductive metals will decouple. We are entering an era where control over physical resources will dictate absolute power. The $715 billion commitment is a declaration of war for physical assets, and silver is squarely on the front lines. Event 5 is the currency war synthesis, the final piece of the puzzle that proves the vulnerability of the entire fiat control grid. The Strait of Hormuz remains effectively closed, acting as a massive geopolitical choke point and creating the largest energy supply shock on record. Sustained $100 oil guarantees sticky inflation, even threatening the unthinkable prospect of a rate hike in 2027. This is the heavy psychological anchor temporarily holding the monetary metals down in the paper markets. But the supposed omnipotent strength of the United States dollar is not an impenetrable, permanent wall. On Friday, the Bank of Japan delivered a massive global shockwave, intervening heavily and unexpectedly in the foreign exchange markets to protect the depreciating yen. They aggressively sold dollars and bought their own currency. Instantly, the dollar index collapsed and physical silver caught a powerful, undeniable bid. This single event proves that the oppressor is deeply vulnerable. Major global economies, from Tokyo to New Delhi, are currently suffocating. The collective pressure from sovereign governments means that the exact moment the energy shock resolves, the chain holding physical assets back will violently snap. We are watching the real-time decentralization of global economic power. It is a messy, chaotic transition, but the ultimate trajectory is clear. The legacy system relies on an illusion of stability, but as the internal fractures at the Federal Reserve widen, that illusion is rapidly dissolving. We are moving from a world built on the empty promises of fiat paper to a world grounded in the undeniable reality of physical assets. Watch the May 8th employment report. Watch the May 12th consumer price index. These are the imminent trigger points. $75 silver is simply the eye of the storm. It is the momentary pause before the violent repricing of everything we thought we knew. You must look beyond the daily ticker tape and recognize the massive structural currents moving beneath the surface. Protect your energy, integrate the shadow of this financial reality, and position yourself on the right side of this historic wealth transfer. The central banks are buying. The technology hyperscalers are buying. The only ones being convinced to sell are the retail investors reacting to fear. Hold the line. Thank you for joining me in the dark. Until next time, keep your eyes open and question everything. See you in the next video.